Welcome back to this detailed explainer of GoldMining Loonie's Week 31. Today, we're actually taking a step back from the fast-paced, high-stress illusion of trading to look at the unglamorous yet absolutely fascinating reality of long-term capital compounding. We're going to examine what it truly looks like when a systematic strategy prioritizes absolute patience over, trying to force profits during a highly unstable week. It's really a masterclass in quiet discipline. Often in trading, the natural human instinct is that action equals progress. But as we unpack the data from this week, we're going to discover that true progression sometimes requires standing entirely still while the storm passes.
So, let's dive right into this masterclass in capital preservation by reviewing the week's headline metrics. And honestly, what stands out immediately? Well, a perfectly flat 0.00% gain, an incredibly low 2.56% maximum drawdown for the week, and an activity level consisting of just one single, solitary trade. Now, to the untrained eye, a 0% return might seem stagnant. It might even feel like a totally wasted week. But in the context of global markets, this is exactly what disciplined survival looks like. In the unforgiving world of algorithmic trading, generating 0% rather than taking a devastating double-digit loss is an active strategic achievement. It is literally the ultimate display of playing defense when the environment demands it.
To really understand why this minimal activity is so significant, we first have to acknowledge the severe macroeconomic storm that battered the markets this week. It kicked off with the Federal Reserve's interest rate decision, which is a notorious catalyst for volatility, then rolled right into U.S. inflation data, was hit by Canadian GDP figures, and finally capped off by the intense anticipation surrounding US Non-Farm Payrolls. Any single one of these events has the power to create massive, rapid price swings that routinely wipe out over-leveraged accounts. When major central banks and top-tier employment data collide in the exact same week, liquidity can vanish, spreads can widen exponentially, and algorithms that aren't programmed with strict defensive parameters can be utterly dismantled in minutes.
Now, this 15-minute chart for USDCAD perfectly captures that volatility. Notice the steep, rapid drop as the market violently repriced itself in response to all that macro data. The currency pair basically fell off a cliff. Yet, right in the midst of this intense downward momentum, our automated system deliberately executed just one single position right on the very edge of the chaos. It didn't panic, and it definitely didn't try to trade every unpredictable bounce. The algorithm simply recognized the structural breakdown, fired its one mathematically calculated shot, and then effectively locked the doors to wait out the remaining turbulence.
Before analyzing the week's microdata any further, it's really crucial to remember our overarching objective here. We are tracking a steady, methodical journey, growing a 2,500 cent or $25 foundation toward a 10,000 cent, $100 milestone. And we're executing this entirely through strict, systematic EA or expert advisor trading. Now, an expert advisor relies entirely on algorithmic logic to remove impulsive human emotion from the equation entirely. When human traders face an account deficit or a wild market, the temptation is almost always to intervene, to try and double down to win it all back. The EA, on the other hand, simply reads the data, calculates the probability, and follows its coding without a trace of anxiety or greed.
And this brilliantly illustrates the reality of that journey. Tracking the growth curve, the account currently sits at a negative 12.04% overall return since its launch. And we aren't hiding from this fact at all. Transparency is the whole point of this explainer. What you're witnessing here is a very measured, patient recovery process from a historical drawdown peak. It's a true testament to the fact that real trading is not just a straight line up and to the right. It's about navigating the valleys. Too many highlight reels out there only show the summits, but by studying the trough and observing how the algorithm patiently chips away at this deficit without blowing up the account, we learn the actual mechanics of long-term wealth preservation.
Delving into the full historical MetaTrader 5 report, the equity currently stands at 2,127 cents against a balance of 2,170 cents. Notice the max historical drawdown of 33.13%. A drawdown, as you likely know, is the peak-to-trough decline during a specific record period. Seeing these numbers is a sobering reminder that surviving severe market ordeals is an absolute strict prerequisite for long-term compounding. Think about it. If you lose your capital entirely during a massive drawdown, the game is permanently over. There is simply no mathematical formula for compounding zero. Therefore, guarding those remaining 2,127 cents is infinitely more important than trying to force a 50-cent profit in a terrible market.
So this brings us to a stark, highly intentional contrast. On one side, we have a volatile macroeconomic backdrop driving massive swings in currency pricing. On the other side, we have a flat, entirely unmoving performance of the account for the week. This is an algorithmic mismatch by design. The system recognized the danger, evaluated the probabilities, and simply refused to participate in the madness.
It's really the financial equivalent of keeping your ship securely in the harbor during a Category 5 hurricane. Sure, you aren't making any forward progress toward your destination, but you also aren't sitting at the bottom of the ocean.
Rather than forcing trades during these wild, unpredictable swings, the system executed exactly one position. Just one. For a human trader, doing nothing during high volatility is incredibly difficult. The urge to act is usually overwhelming, driven by the intense fear of missing out on a big move. But this powerfully proves that sometimes doing almost absolutely nothing is the mathematically correct and disciplined choice. It's all about letting the probabilities align on your own terms rather than gambling on the market's noise. The true mark of a robust algorithm isn't how many trades it can execute in a minute, but its unwavering capacity to withhold execution when the edge disappears.
Let's move over to our risk visualization and see exactly how this defensive stance builds. Tracking the floating equity, we see it briefly improved, actually popping up above the balance line, before reversing into a modest dip as the week's lone trade fluctuated. But what is truly vital here is that straight, unwavering line underneath. The primary balance remained entirely untouched. The core capital was completely sheltered throughout the week. This perfectly captures the essence of week 31. Slight, surface-level ripples in the floating equity, while the underlying foundation of the account remained rock solid and completely protected from the macro crossfire.
The true victory of week 31 is visualized right here in this incredibly shallow drawdown. The data reveals that the account's drawdown stayed exceptionally low throughout the entire week, barely even scraping 1%. When other traders were likely facing margin calls or panic selling during that massive USDCAD drop we looked at earlier, this system proved its primary directive: prioritize shelter over unnecessary risk. By keeping the drawdown so tightly constrained, the EA ensures that it only needs a very minor, standard market correction to bring the floating equity right back to baseline, rather than requiring some miraculous once-in-a-lifetime reversal just to survive.
Furthermore, examining the deposit load, which measures how much of the account's available margin is actually being put at risk to hold open positions, we can see it stayed incredibly conservative at a maximum of just under 0.258%. I mean, really think about that. Barely 0.25% of the account was utilized. This illustrates a disciplined, ironclad risk profile that completely refused to over-leverage, despite the tempting market swings happening in real time. So many systems fail because they dynamically increase their lot sizes to fight the trend. This system actively throttled its exposure, ensuring that even a worst-case scenario on that single trade would be nothing more than a minor scratch.
Analyzing the final weekly MT5 report, the numbers speak volumes in their absolute silence. 0 total gross profit, 0 total gross loss closed, 0 commissions. This total lack of activity cements this week not as an offensive failure, but as a brilliant strategic defensive hold. The algorithm essentially kept its powder dry while the macroeconomic storm raged outside, protecting the balance for better conditions. It's so important to absorb these zeros because they literally represent discipline. Every zero on this page is a conscious, pre-programmed decision to preserve capital rather than gamble it away in a totally chaotic environment.
Comparing this incredibly quiet period to our previous recovery phases reminds us of a fundamental truth of algorithmic trading, one that consistently separates the survivors from the casualties. Robust systems often spend extended, seemingly boring periods simply waiting for the optimal mathematical conditions. As this quote reminds us, consistency and strict risk management will always trump the desire for frequent, action-packed trading. The Hollywood version of trading is rapid-fire buying and selling, but the real, profitable version, it's incredibly tedious, meticulously managed, and fundamentally built on days and weeks of strategic inaction.
As we wrap up this explainer, I really want to leave you with a crucial thought. How will this strict capital preservation serve the journey going forward? Week 31 was defined entirely by patience rather than profit. But by prioritizing that patience and firmly guarding the balance this week, the system has effectively secured the foundation for its future gains. If the capital had been compromised here, the road to recovery would be exponentially steeper. I invite you to keep following alongside as we wait for the market's next move. Because when the volatility finally clears and the setup is right, this account is perfectly positioned for the next leg of its journey to $100.